Vikash Kumar Jain joins us now. Let's understand that what currently brokerages are indicating and advocating to their clients after this strong summer 2023 rally. Right, nice bright yellow tie. That seems to be the mood of the market. Nice, bright, chirpy, right?
Absolutely. So it's taken a time to come, because the first quarter, I remember towards the almost to the last day of March, we were about to create a fresh record of 4 negative months, and that's around the time when it kind of turned around. So it's taken a time to come, but clearly the mood has changed materially from that point onwards. However, we are perhaps at a time where there are balancing factors on both sides. So there is perhaps this popular complaint that we had for a large part of the last 2 years, that India is very extended on relative valuations on many parameters, is now less so a case. It isn't that extended. Like for example, there was a period when India was clearly the most expensive market. That's not the case at the current juncture. However, on the other hand, there is, if we were to try and be imaginative, there's only so much room that we have for significant upsides from that perspective. But from a more near-term perspective, I would say that we should very clearly watch out for how yields in general do, because that is what is going to be a kind of a guide to how markets how much more there is to this rally. And for that point, let's see, even today, the unemployment numbers that come out defines what the Fed will do later in the month. And then our own monsoons, which also we should get more clarity on in terms of how they are progressing in the coming days. So clearly, it's something where after a rally, we have some very important events to kind of digest. And then that is going to decide how much more room we have on the upside.
Because, so what has so far done the trick for us? Is it liquidity? Is it strong earning season for the quarter gone by? Or this is simple readjustment after excesses of 2022? I mean, why are markets going up as if there is no tomorrow? At the beginning of the year, like you rightly pointed out, 9 out of 10 brokerages had a view of a flat year for market. It's turned out to be a good year so far, and we've had good gains in the first half itself.
Well, I think just to kind of maybe bring that point out, it's two parts. Firstly, it's so far not been a great year. It's because we are taking from the lows of March is why suddenly we are feeling so bright, like you said. But if I were to look at, I think we started the year around 18,100 or so, if I remember correctly, then that's something where we've done 3% for the year. Yeah, it's fine, but it's not something, I'm sure we would have underperformed gold, we would have underperformed, the duration bonds, we would have underperformed even or done just in line with fixed deposits. So it's not that we've had a great rally right from the start of the calendar year. It is just that we took a big beating and then we were going higher. Yes, you're right. I think what was happening was October to March is when Indian markets took a breather. October is when India's relative valuations versus China versus the bigger peer complex had become extreme. And then suddenly India actually started underperforming as the whole reopening trade in China kind of played out. Now, what that did was also, it was more like an underperformance rather than any big pullback, because the pullback we had was more like a 10% kind of a pullback, but significant underperformance. And that's where our relative valuations also kind of had a healthy correction. But over the last 1 or 2 months, clearly you're right. It's been up to an extent flows, which has helped India. But that is where I think we need to be a bit more careful, because that is where some problem might lie. Let me just, since it's FII flows which are dominating to a large extent in the month gone by, it looks like, I think that is where some problems can also come in, because China, from their January highs, which is what they hit towards the end of January, is down nearly 20-25%. Now, why that is relevant, I think the best situation for India is a flat to averagely positive Chinese market, because 95% of the foreign flows that comes into India are basket flows. So basically, these are EM or Asia X baskets where money comes in. China creates a big perception to attract that flow. If China is not doing well, my worry is those inflows could turn into outflows again. And on top of it, if there is an event like a recession which creates a risk off in the global environment, then investing in EMs would not be the natural tendency for a lot of these developed market investors. So that's where we could be a bit strangled for inflows incrementally. Maybe there is a little bit of inflows which might come in. Maybe some of the people who had started focusing more on China might start feeling that perhaps it was a mistake. This market is again giving up pretty big and maybe we'll come back to India. But when overall flows in the funds, they turn into outflows, then there's only so much that you can do to drive inflows into India. And this is happening at a time where debt is reasonably attractive in India. So, I do not expect, unlike 2022, where we had significantly large domestic inflows to offset the massive selling that we saw from FIIs. I'm not sure if we can repeat something like that this time. So that's something where we should be a bit careful. So ideally, China falling much more eventually is going to have an impact even on our market.
Fair. Because the consensus positioning in the market is around financials. Do you think it's a consensus which will ensure that the upside and the future gains will also be compromised? Because, they always say that majority never gives you best gains.
Well, I mean, that obviously there are times in which the trick about doing this contra thing is to know when to be contra. I would say that, yes, you're right that at a particular point, there is a lot of money to be made for investors who can play the contra trade very well. And for us, like, for example, we have this our proprietary India Bull Bear Index. That has really helped us in giving a sense on when we should be contra on the market. Like, for example, right at the exact low of March, that indicator gave us an extreme bearish signal that everybody was very bearish and it had become almost consensus. And that's when we turned bullish and added beta to our portfolio. But I would say that is something that we should kind of look at it. But there are ways to look at it. Is positioning so heavy is one way, but on the other hand, our valuation is so stretched. But even within financials, if you look at the nature of the rally that we've had from March, it's something which is again brings me to the point on yields. The stuff that has done well is actually more the kind of stocks which gain from lower cost of funds in terms of yields falling, whether it is real estate, whether it is NBFC, or whether it is the less big bank or the smaller banks, which are more dependent or less dependent on CASA. So essentially, that is why with having breached below 7%, I think I am still not sure if we can go much lower. That's something which we'll have to maybe the monsoon or what the Fed does will define that. But if we do not have incremental gains on that side, can these same set of stocks really lead the rally higher if yields do not have further downside is something for us to see. So I think within financials also, perhaps the flavor has changed more towards the NBFC kind of stocks. So I think there is still, that is a consensus trade. In fact, we are also part of that consensus trade. There will be a point where this whole rally in terms of yields play out and we get more and more certain about rate cuts. And historically, what we have seen, the point when we get close to rate cut is the point where globally, somehow technology starts doing better than banks. Closer home in India, perhaps technology has some bit of digesting to take in terms of how bad demand could be. But I think if that plays out through the commentary of the upcoming quarter and there is further rally in banks, we could get to that point. But I'm not sure if we are there yet on an overall financials perspective.
Hi Vikas, this is Anisha also joining into the conversation. I just wanted to roll back to the initial answer that you were talking about, that you're not very enthused by the market rally at this point of time because we've only seen a jump from the March lows, but on a YTD basis we're still flat. And I also understand that you've cut your EPS estimates for Nifty by 2 to 3% after this earnings season. What does it do to your own assumption of the Nifty levels, let's say by the end of the year? What is the realistic return expectation that you have for the calendar year 2023 now?
That's a fair question. So I think, yes, our analysts did cut estimates by about 2 to 3% for Nifty companies overall. With that, we are now 3 to 6% below consensus on Nifty EPS. Now, if I were to use, we have this favored valuation benchmark where we try and compare equity valuations to bond valuations. We favor that much more than the absolute PE, which is a popular benchmark when looking at equity valuations. And if I were to, that is right now, somewhere between average and stretched. That is where it is in terms of difference between bond yield and earnings yield. If I were to assume that, what is the bull case in this situation? That is, if I were to use the bull case or stretch it out with assuming that yields stay at about 7% or so, and you use CLSA estimates, then in the bull case, we have about a 10% rally or so, maybe somewhere between 2,500 to 21,000 is what comes out as the bull case at the end of this calendar year, since that is the question, which if you were to kind of take a look back, would be in the bull case about a 12-13% return from the time when we started a little over 18,000 in terms of the year. But in the base case, we see a little bit of a downside, a small downside from here to now, to the end of the year. So basically what I'm trying to say is that for a market to have a much stronger rally, more room has to get created by yields falling even more. And for that to happen, perhaps we need to get more in both in the US as well as in India, get further certainty that inflation is cooling off rather dramatically, or and in case of India also, the monsoon is okay and we don't have to worry about agri inflation in terms of food prices. So those are the things which need to play out. We also need to keep in mind that market in a way has, after the last RBI meeting, has in a way now started anticipating that if there will be a cut soon, if there are political compulsions going into the national election early next year, will the government be far more focused on inflation and not give a cut before that? That's the other thing that we have to need to deal closer home in terms of the politics, which becomes more and more active as we get towards the end of the year. But that's really your answer. In the bull case, another 10% kind of a rally using our estimate, which are 3 to 6% below consensus.
Vikash, hi, morning. While you have been walking us through your strategy as to what one should do, there's also what not to do. And one of the lessons learned, as per your report, is that avoid getting overly tactical. Can you just walk us through examples of having done this, or any, classic mistakes that you'd say now can be avoided?
So, I would say that there is a balance here. In our discussions with fund managers, we find two more popular trades, particularly for people dealing money with India. I think there is a bigger population of fund managers who are far more micro and stock specific. Okay. And on the other hand, there is also a section of fund managers who want to, avoid being tactical at all. I would say there is clearly some kind of a balance which is needed. And it's really to find that balance, because at times what you might call as tactical can lead to 10-20% moves in stocks. Now, particularly if you think about the markets that we've been over the last 2 years or so, which is the market has been largely flat. I think, the note that you're referring to is the one where we talk about, the hits and misses for our portfolio, which we've been running for about little less than 2.5 years. And it's a large and liquid stock focused portfolio. Now, in a large and liquid stock portfolio, when the Nifty is flat, that is for, 2-3% up in the matter of 2 years, you need to get more and more active about it. So, you can't really say, and that's where I was saying that maybe our proprietary bull bear index has done pretty well in signaling us when there is an extreme point for the Nifty, and we've kind of accordingly moved beta in our portfolio. There is one example that I do highlight of a particular stock where we were okay, and we were pretty, uh, uh, positive on their longer term outlook. I got a little bit too worried up about the more near term news flow, which could have been a bit more negative. And that's where I kind of became more tactical about it, and did miss out on the opportunity to correct my mistake later. And that stock went up to outperform Nifty by some 40-45 percentage points in a matter of less than 2 years since I exited. So that's a mistake that I did do at that point of time. So, it's really to try and find the balance. That was also, within the first 6 months of me trying to run the portfolio. So that's a continuous learning process. And, maybe that's one clear mistake that I have highlighted. I hope to make much lesser of them going ahead. Let's see how it goes.
Well, Vikash, even if you have like a 60-70% success ratio, it's more than enough in this market, right? But I'm curious, is that mistake Bharti Airtel or ITC or something else?
See, I think, let's not get into stock specific, but the note that you have already
Sure.
mentioned. So, it's something where clearly there are certain misses that are also there highlighted, which we just did not look at. Some of the reasons for that is we were not sure if having them in our portfolio would make any sense, because many clients were worried about ESG concerns. So there was that two minds that we had in. So they were absolute misses. They never featured in our portfolio, but these were star stocks, and we should have thought more deeply about them. But there were others where we exited at the wrong time. And so, there are these mistakes which we have highlighted.
I think I get it from the note that ITC, Power Grid, Coal India were the misses that were never a part of the portfolio, and Bharti Airtel is something that you perhaps exited a little too soon. But Vikas, just coming back to the point about the divergent move that we are seeing in the market at this point of time in the large caps versus the mid cap and small cap space, the likes of Reliance, HDFC Twins, they have been stark underperformers. Do you expect this trend to continue for the rest of the year, especially on Reliance and HDFC Twins?
See, part of us should actually be happy about this trend. In fact, I would say India is one of the more unique markets where it's a much wider rally. And that's why, I am still not willing to call for a top here. Because if you were to look at participation, it's quite encouraging, which is very different from, say, the US, where the popular complaint is that it's a very, very narrow rally. It's only a few stocks, the AI basket and the NASDAQ stocks, which are driving the rally, and the wider market is just not participating. That in a way gives a sense of the kind of bullish trend which is there. Perhaps it's part of that whole multi-year bullish India story which is there. And that's why when people kind of came back in terms of FII putting money into the stocks, they were willing to find these ideas and go much deeper into the market because of trying to play the longer term trend. So part of it we should be happy about. But on the other hand, since, we could, if this rally has more legs, we could get to a point where we are getting more stretched. Some of these names, if they, the couple of big names that you have highlighted, some of them, if they are at more attractive valuations, I would say that one needs to be very careful about not being significantly underweight on those names. Because what could happen is if suddenly the market's mood changes, these could be seen as, and people tend to hug the benchmark, these could be seen as places to hide. So it's really, from that perspective, there's a part of me which is happy that it's a wider rally. But on the other hand, as we get more and more stretched on this rally, we should not lose an eye on some of those names because they start showing their more defensive characteristics in a situation where people want to actually get closer to the benchmark.
Mark Mobius said, yes, it's possible. Chris Wood said he'll be disappointed if it doesn't happen. Shankar Sharma said he's absolutely certain it will. I'm talking about the Sensex reaching that coveted 1 lakh mark. And of course, it's now only a matter of time. But what is your thesis, given the fact that we are growing at a healthy clip for the economy, as to when this could potentially happen?
See, I think the trick for a strategist is always to not give the timing and give an opinion and just stop there. So, I would say that clearly we are in a multi-year bull market for India, but within that, we are not in an island. We must, in all of this bullishness, there could be periods where the markets might have 20-30% pullbacks. We had one recently. the top in October to the point when in October 21 to June 22 was a 20% pullback, which happened all within this reasonably strong macro and all of that. So it's many a times it's more about your timing versus mine. Maybe everybody can be right about it. It's really the timing, and basically like there's that famous saying by Warren Buffett that is going to be volatile. So it's basically volatility is going to be the name of the game, and even within that overall bullishness, we need to keep our eye on the fact that there could be periods when things get stretched and there will be pullbacks. Those should be, if you are rightly positioned, could be used as great entry points to play that longer term. So it's really, I would not hazard a guess on the timing, but clearly I think getting there should not be much of a doubt.
As to not give out the timing of when we'll reach that mark. But Vikas, I remember the last time we spoke with you, you called IT that could be one of those tactical trades that could play out, and it's really played out very smartly, especially in the mid cap and the small cap space. Tell us, what is the next tactical trade that you are seeing with sector, with stocks?
So I would say that, that's, at times there are 3 or 4 big parts of the market. Banking and IT are clearly the two of them. If one, since our portfolio is a large and liquid portfolio, it's very important for us to get the choice between the two right, because that might very well define how we do on the portfolio. We were lucky enough to actually, that was coincidental, because like I told you that towards the end of March, we wanted to add beta to our portfolio. And in that process, we actually went significantly underweight IT. We got rid of one of the names, which within days, luckily for us, had a big collapse. We are right now pretty underweight IT. There could be a point where we start getting more comfortable about cuts by the US as well as Indian central banks. And that is where, by that time, if IT valuations become even more palatable, there could be a point where there could be a shift in favor of IT against banks. I don't think we are at that point yet, but yes, that could very well happen in the coming months. So that is something that we should kind of bear in mind, but not really acting at this point of time. At this point of time, from the point of that March lows, we've been very bearish on IT, very underweight on IT.
Okay, it's interesting to get that strategy from you, even though you didn't divulge too many details about your regrets or timelines for the Sensex hitting 1 lakh. I think it's sufficient that you've really shared with us your overall market outlook.